Welcome to Investing in Startups. I'm Joe Mager. Our guest this week is Morgan Flaker, managing partner of Silverton Partners. Silverton's an early-stage firm that's had more than 30 companies IPO or get acquired. We talked about the art and science of portfolio construction, when to bend on price, and which of team, product, or market is most important. Please enjoy. Morgan, thanks for coming on the show.
Thanks for having me. Looking forward to the conversation.
Yeah, it should be fun. I know you and I had, along with a bunch of other investors, a fun chat recently here in Austin, and just seemed like a good excuse to bring you on the show and talk shop. Silverton's been around for a long time. I thought maybe a good jumping off point would be to just talk about Silverton's strategy.
So we're an early stage investor, typically writing, I'd say the broad scope is $1 to $10 million checks. In practice, kind of the sweet spot tends to be like 3 to 7 for us. And we're generally investing, we call it early product market fit. So handful of customers, a little bit of revenue. That's kind of like the dead center for us. And then because I'm a big fan of investing in the best things and rules are kind of meant to be broken, we do things on either side of that. So we'll do some pre-product, pre-revenue things. And then occasionally we'll find something that we found too late or bootstrapped itself kind of past that $800K or $1 million revenue mark that we're excited about. And we'll do those as well. But 70-80% is kind of in that range. We are in Austin. We look across the country and occasionally internationally. But because of our tenure here, being in Austin for now 20 plus years, like I would say 60% or so of the deals, roughly speaking, that we do are in Central Texas, and then another 10% kind of rest of Texas. And then the balance, which works out to about 30, that tends to be pretty well distributed primarily across the US. So somewhat of a geographic focus. We don't have a mandate. It's just that's where a lot of our deal flow and a lot of the exciting opportunities are coming from. So definitely focus here. And then in terms of what we do, broadly speaking, tech, but the biggest practice area is B2B software. So enterprise software in some ways. We've always had a practice there for the past 20 years. So that's the majority of the businesses we fund, but we also do consumer. We'll do some fintech and insurtech, and occasionally we'll do some business services. So fairly broad kind of mandate across tech.
Okay. And what does the team structure look like?
Yeah, so we have 13 folks today. So we've got 5 partners. We've got a handful of like junior investment professionals, which range from like associate, principal. And then we've got 2 admins and a CFO and an intern. So initially when I joined, which was back in 2006, right? So we were getting started. I think we had 4 people at that point. So we've grown the team a bit since then, but still kind of very much a small firm. We're all co-located here in Austin. We come into the office every day. So we're a bit, I don't know if it's old school is the right terminology, but we're a bit traditional in terms of like how we run the business. And it's kind of been that way since the beginning and we haven't really changed it, but that's high level, kind of how big we are and how it works.
You moved to Austin back in 2006, came from California. At the time, that was probably a fairly non-consensus move. And I'm curious, in hindsight, what was the response you got from other investors when you told them pulling up?
Yeah, definitely non-consensus back in 2006. And I was at FTV Capital at the time. And that firm has gone on to be very successful. I think for them, we're probably 10 billion plus now. Back when I was investing with them, we were investing out of a 400 and I think $20 or $30 million fund. And it was very much a growth oriented vehicle, which is kind of funny to talk about now because there's seed funds that are in that range nowadays. So like there's been some inflation within the VC ecosystem. But anyway, so I was there and I got introduced to this guy, Bill Wood, who had been in Austin a long time. He had co-founded Austin Ventures and was a managing partner there. And I actually got introduced to him under kind of a weird context. And it was, I had received an offer from another venture firm called True Ventures in the Valley. And I was trying to decide if I wanted to stay at FTV or go over to True. And he was kind of introduced to me as, hey, this is somebody who's been in the industry a long time, has a lot of great experience. You should get advice from. And he was also removed from the Valley, which is where I was. So he had less direct connectivity to kind of the people involved. And so I thought I'd get like a very objective point of view from him. So I flew down to kind of talk to him. Part of his advice was kind of walking me through the Austin market and what he wanted to do with Silverton, which I had no knowledge of kind of prior to coming down. And then, after spending a couple of days with him, he kind of insinuated that there was an opportunity to join him and that he really was trying to build the team out, and then kind of followed that up with a kind of a more affordable offer shortly thereafter. And it was an interesting decision. Obviously, I made the choice to come down here. And basically, the premise of my thinking was, it was kind of based on me having spent 7 years as a founder and a few years as an investor, is like, hey, it's an asymmetric return environment, meaning like a very small number of opportunities produce the vast predominance of kind of the liquidity in the market. Those tend to accrue to the very best deals. And there's only a handful of firms that actually see the very best deals. And at that time, like, my point of view was, hey, FTV is later and we're not really in the upper tier echelon set with at the time, Sequoia and Benchmark and Kleiner and those folks that were seeing those. So I kind of felt like we were trying to make it happen, not being a top tier investor, or at least perceived that way, which was working. But Bill kind of had made the case that in Austin, he had a tremendous track record personally when he was at Austin Ventures, and that he felt like he had unfair access to kind of the best entrepreneurs in Austin. So I thought that was interesting and spent a lot of time verifying whether or not that was the case. And, I came to the conclusion that it was, after talking to a bunch of people in Austin. And it was early stage, and early was interesting to me because I kind of felt like I like to have an impact on the things I'm involved with. And I think the opportunity for impact is just so much greater at an early stage. Not that it isn't possible to have impact later. It's tougher. You take like a $40 million revenue software business and they're going out to raise money, and like, as long as the metrics are decent, like, somebody's going to do that deal. It's just a question of like, at what price. And then you can probably bend the business direction 15 or 20% at that point, but it's got a successful business. It's turning over. It's kind of got emotion. And so the ability to affect it is less. Obviously, at the early stage, it's like, hey, if you don't make that investment, that business might go away. So just very much different impact. So anyway, I decided like both those things were interesting, made the choice to come down here. And you asked, what are you doing? Because like, two offers from two pretty well-respected Silicon Valley firms, and making the choice to come to Austin wasn't kind of understood. And yes, the process was like, hey, let's go create the firm here in town that sees the top 1% or 5% of deals and has an unfair advantage to win them. And if we can successfully find that, even though Austin at the time was a smaller pool, we're going to be successful as a firm. And as long as we don't try to grow assets beyond the capacity of the market and kind of outstrip our advantage, like, we ought to produce successful returns for investors. And so I kind of explained that to folks, and I'm not sure everybody really got it at that time in terms of agreeing with the logic of that strategy. So just kind of had to keep putting my head down and cranking and showing the efficacy of the logic there. And obviously, if you fast forward 15 years or whatever, like, it started to kind of make more sense to people. And then, obviously around COVID, there's this great migration here. And then everybody's like, oh, you knew it before everybody else. And, I'm not sure that was the case.
What was the biggest culture shock you had going from venture in the Valley to venture in Texas 19 years ago?
I would say that it was a positive culture shock. I mean, I'd say like the biggest negative was just the volume of opportunity set back then. I mean, that gap has closed a little bit in the past 20 years, but back then, the Valley, which is still the case today, was just kind of deluged in opportunities. And in Austin, the opportunity set was smaller, but it's also like a little bit more like tightly knit, right? In terms of like the number of people who had really successful outcomes was smaller. They knew each other. Reputation was a much more important kind of part of it. And so you kind of had to break into the network. And that's true anywhere, but I think it's particularly true in like smaller places because, the Valley is big enough where, if you screwed over an entrepreneur 10 years ago, like, that person could be lost in the mix. If you've done 20 deals and one of them just kind of went out of business and disappeared, like, the idea that could be forgotten and not found out, or at least not shouted from the rooftops, was pretty high in a town where there's 30 people who all know each other, who are kind of like super high potential entrepreneurs, the idea that that's going to happen and people aren't going to know about it is pretty much non-existent. I actually like that a lot because it was, that works two ways, right? Like if it's positive, those get reverberated in a positive way, and it's negative, then obviously the converse is true. And so my thought process was always like, hey, here's an opportunity to kind of really dig in, do right by people, and then have that positive feedback kind of start a loop where, all of a sudden you're differentiated as a firm and as an individual. And that's a little bit easier to do in a small ecosystem. I like that aspect of it. The thing I was surprised about the most was probably how open folks were to new relationships and connections. It was almost like, hey, we know, at least at that time, we kind of have one arm tied behind our back to be successful as an entrepreneur, because like the supply of capital in Austin and the number of folks doing stuff in the network is just so much smaller. And everyone just kind of wanted to help each other out. And like, hey, a success here was something that helps you indirectly because you're kind of another step closer to putting Austin on the map and getting more attention and capital here. And so you kind of wanted everyone to be successful at some level. And the ecosystem was small enough that like, hey, the chance that you have a direct competitor in Austin was pretty low. So people were a little bit less guarded about it. I was kind of pleasantly surprised by how open and accepting and people's ability to and willingness to share information. The Valley, obviously, there was a bit of that as well, but people were a little bit more guarded in terms of like who they're talking to and what they're saying and who they're embracing, just because obviously those things aren't necessarily true there. So that was a kind of a positive surprise too.
You mentioned discipline on fund size earlier, and I thought that'd be a good chance to dive into portfolio construction. How does that look for you today, and how has that evolved over time?
So we roughly do like 20 to 25 deals in a particular fund. That actually hasn't really changed in the past 20 years. Like our fund sizes have gotten bigger. So our initial fund back in 2006 was 75 million. We're on fund 7 now. Like that vehicle was 177 million in capital. So just a little over double size in 20 years. So obviously if you do the math, we're committing a little bit more to opportunities over time. I mean, how I would describe it is, I mentioned round sizes have gotten bigger and funds have gotten bigger. Like we've tried to pace that for the Austin environment and for the size of the rounds that we're investing in to basically maintain the same strategy. So the stage that we're investing, I kind of described it earlier, hasn't really changed. The rounds are slightly bigger. And that really the only difference is now that the funds have gotten bigger, occasionally we'll be able to participate in a later round that we may have not had the possibility to do in the initial one because we were kind of tapped out from a capital perspective. And kind of sounds like an accident maybe in terms of that, but we've actually that's the core premise that we build our portfolio construction around, which is we don't want that disproportionate amount of the capital to go in at a later stage. So we don't want to say, hey, we used to invest 40, 50% of our capital upfront, and now we only invest 20 because we're just playing the option value and like playing in later rounds because we have a bigger fund. We kept the fund size small such that still to this day, roughly like 40, 50% of like whatever we're going to commit to a particular opportunity comes in the first check. Like that aspect of it hasn't really changed a lot in the last 20 years either. So the majority of the capital is still going in at a seed stage. That's by design as well, because we think obviously the return potential is highest in that initial stage. We're a little different in the sense that for some seed funds, it's even higher percentage goes in initially. Like in some cases, it's like, hey, we're going to lead the seed round and we're going to put in 70% of our capital. And then we're just going to do our pro rata, or maybe not, like in follow-on rounds. We do save a little bit more because like our analysis has shown that we're pretty good at distinguishing between the opportunities that are working pretty early on and the opportunities that aren't. And it's definitely not a perfect science, but us holding back a bit allows us to kind of concentrate capital into what we perceive are the winners, and that produces alpha for us as a fund. And so we haven't really wanted to mess with that too much. other than to try to get better at it, which I would like to say we have, but like it's a tough thing, but I think we do a pretty good job of it.
I appreciate it's not a science, but on the artistic piece, what are the hints for you that were signs that you're like, look, this is something we might want to be aggressive about with pro rata or just coming in with more dollars?
This is the part that sounds like motherhood and apple pie because it seems like it's so easy, in the sense that like, yeah, if the company is growing at a fast rate and the team is executing well and they're hiring good people and like all the things, like the initial signs that you would expect of like, oh, this is an opportunity that's working, or the market is like coming around in a way where like the pipeline is increasing at an exponential rate or a quicker rate. Like there's all the SaaS metrics around that in terms of like sales marketing efficiency and magic number and CAC LTV and net retention and like all those things you can look at. And obviously we do those things. And I think we're pretty sophisticated in terms of like how we look at metrics and how we make decisions. And I'm a big fan of data-driven decision making. So like that's a big part of it. I'd say the hardest part is the converse, which is like, how do you know when something isn't working? Because like you can always come up with examples. And I have several in my portfolio where it's like, hey, the company started off doing this and almost went out of business. And then they pivoted 50 degrees and then it became a $2 billion company. Right. And those stories are real. Like we could debate the probability set and all that kind of thing, but like there are a lot of those stories out there. And so if you're in the mood of justifying another check into a company and why things are going to be different this time around, like you can most certainly do it. A lot of times those could be mistakes. And so I think the most important attribute of making a good decision is maintaining objectivity. It's really hard to do, but if you can look at it in the same fashion as you can, like a new opportunity that just came in the door, it's definitely like it helps with perspective and understanding like, hey, am I too close to this? Or like if this walked in the door, would I really be jumping up and down to write another check for this or not? So I think that's a part of it. We've also implemented processes, I would say, to improve objectivity where we all rate in an anonymous fashion, like each other's, like the partners basically rate each other's deals from a reserve standpoint. So like, and I'm going to give you the super simple version, but basically like I rate everybody else's opportunities from 1, meaning like that's the best opportunity we have. We should absolutely put more capital into that until whatever 18 or 20 or however many companies we have. And then our CFO tabulates that and we see an anonymized, like crowdsourced like view of like what the partnership kind of thinks. And the reason why we do it in an anonymized way is just to avoid politics, which is unfortunate that those things happen, but they do. And like people thinking, oh, well, you voted my deal last, so I'm going to vote your deal last, or you voted my deal first, so like I don't want to vote yours at the end of the thing. And like those kind of petty things happen and affect decisions. So this is just a more effective way. And so even if you think this company is doing the best and deserves another $5 million, you're kind of slapped in the face with hopefully a slightly more objective view of the partnership. And then when we're actually doing reserve decisioning, if your deal was voted in the bottom third and you're trying to make the case that more capital should be allocated, you kind of have to make it under the context of that data, which is not impossible, but is probably unlikely, or at least.
Yeah. It probably means you're either missing something or you're not selling what you see effectively to your partners. And one of those is true.
And we don't weight it by like ownership in the partnership or like percentage of carried interest or anything. So like me as kind of like the managing guy, the most senior guy, like my vote doesn't count any more than anybody else's. And that's deliberate as well, because like I can breathe my own fumes as much as anybody else can. We have some decision assist things that kind of help us make some of those decisions better. And again, you're never going to bat even close to 1,000, but if you can improve that even incrementally, that's kind of the difference between a 2.2x fund and a 3x fund or 3.5x fund done right. And 3.5x fund is going to raise money forever without any questions and people are going to be lined up at the door, and a 2.5x fund might still raise money, but the environment and circumstances are going to be quite different in terms of how that gets done. So it makes a difference.
Maybe to swing the pendulum the other way and talk about secondaries. So, as you're saying before, if you did a seed round or an A and business is flying, that's usually not a hard decision on whether you come back and write another check. But a trickier one is the business is going so well that valuation's gone up a lot and there's interest to buy your stake in a secondary. But at the same time, you're thinking about, do I want to take something off the table? And that feels like a lot more nuanced discussion. What do those discussions look like for you?
It's a fairly organic conversation that's driven by some event. We're early, so a lot of the companies we're invested in, our initial check is at a sub $20 million valuation, occasionally sub 10, right? So anytime we have companies that are raising money at, 250, 300 plus, there's kind of an implied kind of point of discussion of like, hey, how are we thinking about this? Like, do we want to take capital off the table or not? And is there even the opportunity to take capital off the table? So like, but if there is, and those rounds have those dynamics, it's kind of like it's a discussion. And the nice thing that we found is it's a lot easier if it can be 0 to 70% and not like binary where it's like all or nothing. Because for us, like we may have, and this is often true, like it's our best assets that are generally producing outcomes that have those characteristics. It's pretty rare with those assets that we feel like, oh, we got to get out now because if we don't, like this thing could become a 0 shortly. Like if we ever feel like that, then that decision is obvious, right? Like let's go take as much as we can get at this price. Oftentimes it's the business is performing well. It's going to continue to perform well. Like, how do we think about that? And how we think about it is like, there's part of it that's like a time element, right? So our funds have defined lives, which is like a 10-year fund with extensions that can go to 12, 13 years, right? So like if we're nearing the end of like a 10, 11-year hold and we think that the new sponsor that's coming in that could buy our secondary is going to want to hold it another 3 to 5 years, which is pretty typical, like that decision becomes a little bit more auto in the sense that we're selling at least a majority of our position, maybe 100%, but a majority just because we owe it to our investors, to make good on our commitment, to give them liquidity within the time that they want. And occasionally we'll do fancy stuff like allow them to continue to hold the shares or buy the shares from us in that transaction so they can continue to hold them if we're super bullish on the company and believe that advice is correct. So time is an element. And then the other element is just kind of taking some risk off in the portfolio. So we've all seen it. 2021 is, or not all of us, I should say, but if you've been in this industry, like I've been there 23, 24 years. So like if you've been here long enough, you've seen cycles and this perception that everything's always up and to the right isn't necessarily true. And so like, I guess what I've learned is, hey, if you have the opportunity to sell 10 or 20% of a business and make 5 to 10 times your money, and we've had several of those, like you're generally advised to do that, even if you believe it's going to continue to run, because it's such a big win for the fund that it just makes sense to take a little bit of the risk off, put some cash in the bank and let the balance roll. And rarely is a decision going to be second guessed where it's like, hey, we sold 10 or 20%, we produced like 5 to 10x. And yeah, we could have made a little bit more had we kept it, but no one really cares because you're so in the black. Whereas if it goes to 0 and like that was carrying your fund and you had the opportunity to sell and you didn't, like those decisions are often second guessed and for good reason. So there is a little bit of an element of like, all right, like do the smart thing. And I guess the thing that I've noticed, like one of the other things we've done at Silverton is like, we lend money, especially to the junior folks, but even to the partners as well, where they can invest alongside the fund in deals. And it's kind of like, why would you do that? Obviously, it comes out of my pocket and some of the other partners' pocket to like lend money out in that fashion for people to invest. But I think it changes the psychology of someone because, and I've seen it in action where if someone put in 20K to a deal and now they can sell half that or 30% of that and make 200K, right? Like their decision is always like, oh, well, let's play with the house money, right? Let's take some off and we'll still leave some to ride, but let's cash in while we have the opportunity. When people have their own money in deals, I've seen the propensity to do that be quite high. When it's other people's money and it's almost like paper money or carry at some point in the future, the propensity to just be like, hey, well, like just let it ride. It's going to be worth more in the future goes up quite a bit. And I guess how I think about it is like we're servants to our LPs. And so like our mentality should be an LP mentality, not like a GP option carry mentality. And so, yeah, behave like an owner, maybe, I guess is another way to say the same thing. So, when you kind of see that behavior, you want to institute that as a process within your firm. And so occasionally I'll make it mandatory. So like during 2021, the psychology that I was just talking about. So like anything where we could sell basically like sub 20% of the business and get a 5X or better from doing so, like it wasn't an option. Like we're selling between 10 and 20%. Like I don't want to hear the explanation as to why we shouldn't. Like just go get it done and we'll talk about it if you want to sell more than that. And of course, in retrospect, it should have been 40 or 50% and instead of like 10 or 20, but that's what I can kind of rationalize with the rest of the partnership. So occasionally we'll create rules around that if we think the market pricing is dislocated from reality, but like that isn't very common. It's mainly a discussion.
Most conversations around portfolio construction and venture go around winners, which makes sense because of what drive returns, power law-centric industry. But I'm curious, and you've had a number of funds over the years, so you'd have a fair bit of perspective. For the companies where you invest that manage to survive, but they go into like cockroach mode or lifestyle mode, and you start approaching end of fund life, and I'm sure it's a wide variety of situations, but how do those situations get handled when you're getting near the end and you're like, look, we got to find some kind of exit here, but the founders and in any kind of rush to pursue a traditional venture path exit?
There's a lot of dynamics there, but one of the more important dynamics is usually we find ourselves like fairly aligned with the founders in the sense that like, hey, if you've been at this for 10, 12 years, right? Like you're probably looking to try to get something out of it as well. And so like, hey, we all want to have this wrap up within a predefined time period of some sort. And so if there's agreement there, it's just a business conversation of like, hey, we're not accreting that much value. Does it make sense for us to consider options? Maybe I know this isn't what we all got into it for. And then in some cases you need to create incentives, like if they're way underwater from a pref stack perspective and aren't going to make any money on the equity, but yet you're asking them to do it, that's kind of fair of like, okay, well, then can I make this more attractive to you to pursue this? And there's all those kinds of tools and techniques as well. There are some investor friendly options like redemption and other things, which are kind of like a hammer to force that sort of behavior if there is an agreement. We haven't really had to use those mechanisms, and we don't have that in a lot of our deals.
Let's say we're talking about a mature seed or Series A, and you had to rank product, founder, and market in order of importance to you. How would you rank that and why?
Yeah, I've never had it posed as like founder versus like team. So like the concept of founder to me is like, it's probably more important as part of the initial investment because like at the stage that we're investing, there is generally obviously a team, but like it's super early and most of the bet is on the founder or founders. Over time, it becomes very much like a team. Like the more mature a company is, in my opinion, and the more built out the team is, it becomes more of a team decision. But whether it's founder or team, like I pretty much always choose team first. And like, it's kind of a cop out answer, but I think it's appropriate because good teams are generally like really smart people and they solve for some of those other things, right? So like a really good founder who's had success in the past and potentially made some money doesn't really want to go after a niche market, right? Or isn't generally going to produce like a terrible product if they built good quality products in the past. And so like, if you're going to pick one thing, it's kind of like, I'll pick that because they're probably smart enough to go after a decent market and they have the capability to build a decent product. Occasionally we have seen circumstances where, being a founder is different than being in the investment business, and how you think about markets and analysis could sometimes be different. And so like in the process of vetting a deal, we've often imparted information or imparted perspective to a founder or a team, about like, well, maybe their perception of how big the market is differs from ours. And generally, again, with good teams, and if it's a logical discussion, like they'll come to that conclusion as well. So we have seen sometimes good teams initially start to go after markets that we may not be as attractive or attracted to. And it's more of an iteration of like, hey, can we change, the point of the spear market here so that it's bigger, or are there opportunities to expand it in the future, and those kinds of things. And it's an iterative conversation, but generally teams pick pretty decent markets, but those two are at the top, right? So like sometimes we'll back inexperienced teams because we love the market opportunity. That's probably 20% of what we do, which is like, hey, we know this is a really green first time founder, but we love the space they're playing in and the opportunity they've identified, and we just have to participate in that. Like that's a non-zero set of opportunities. Oftentimes it's people that have some experience that we really like that are pursuing A markets. That makes it super easy. Or even if it's a really good person in a B market, like I'll take that over a C team in an A market. I'll take an A team in a C market any day.
What's a question you love to ask founders?
I mean, I'd say it's kind of two things. I always love to hear like the origin story, not just like jump into like, tell me what your product does and tell me about the market opportunity. It's just like, well, how did you, like, what was your journey to get here? The reason why it's important is, I'd say the most important thing about it, you can tell like the passion, like what connection do they have to that problem? How passionate are they about solving that problem? Like generally that comes across, I think, better than anything else in an origin story. And some people are like very upfront about talking about their passion for the particular problem. And sometimes that's genuine and sometimes it's not, to be honest. But in an origin story, like the journey there, I think tells that better than anything else. And there's all flavors. Like there is no one like, oh, this origin story is so much better than that one. But I guess the way that I would describe it and why passion is important is like being a founder is like freaking hard, right? And pretty much all the companies, even the most successful ones, like there's some dark, lonely days where it feels like you should give up, or it's like, what am I even doing? I've been spending all this time and effort and it doesn't seem like I'm making the progress that I'm willing to make. And if you don't have a connection to the people around you and the problem set and have a passion for the solution that you're bringing to the table, like your propensity to like want to give up or take the easy way out or like just kind of somehow find your way out of it, I think is just higher. And you have to be able to kind of fight through that in some cases. And my perception of people's willingness and ability to kind of fight through that comes across, I think, in the origin story.
What's a conventional view in venture that you think is BS?
I'd say the easiest one is obviously there's some huge outcomes. And so I've seen really smart investors occasionally talk about what I believe is a fallacy of like, hey, for the best opportunity, like you could pay any price because if you believe this is a $10 billion outcome, like does it really matter if the seed is at 50 or 150 or 200 or whatever? And it's kind of a justification for, I guess, paying up or paying any price. And obviously mathematically, if you knew something was going to be a $10 billion outcome and you could get into it for any price in that range, like it's a math equation to say like, yeah, of course you could do that. The issue is like, people can't tell the difference and they think they can. And so anybody that thinks that they can tell with a high degree of certainty what's going to be a $10 billion business when it's pre-product or 100K in revenue. Like, I just call into question the accuracy of that statement. Or maybe you're just way better than I am. I don't know, but I just haven't seen anyone be able to kind of do that like super reliably. And so I think, but the real question becomes is like, hey, if you have a portfolio of these, knowing that the exits are going to be like distributed across like the typical exit graph, which is like, obviously like the vast majority of outcomes are sub 50. There's another tranche that's pretty big that's between 50 and 200. Then it gets much thinner between 200 and a billion, and then sub a billion is like a small fraction of 1% or whatever. So if you just like distribute kind of your entry valuation across that where things are exiting graph, like I think it's a stark representation of like what your return profile is potentially going to look like. And obviously like some people are going to be better at picking outcomes, but this regression to the mean, or at least propensity to go to the mean, I think you just have to be conscious of that. And like people that believe they have superpowers like generally don't last very long. And I've also seen people who they'll have one of those incredible outcomes, or a fund will have an incredible outcome. And then to me, it's like, okay, but like, can you do that consistently? Because LPs that invest in this asset class, they want to invest across multiple funds, which is like decades. And they're only going to continue to do that if there's some consistency in the returns. I'd be careful of that fallacy. Now, every once in a while, if you want to take a flyer, like, and you have strong conviction, go for it. But like in general, building a portfolio that looks like that, I would say probably isn't going to end well.
Yeah. I find an interesting dynamic where the investors I meet who are the biggest proponents of, look, I'm willing to pay any price because I'm about upside capture for winners, they also tend to be ones that have super diverse portfolios, which kind of runs like a little counter to the logic for the point you were making of like, well, if you do that at the portfolio level, it's kind of hard. And two, kind of goes against the whole point of picking. Like if you think of yourself as, I do think I have an edge as a picker, ironically, you're paying, call it like A valuations for seed traction team. It just feels like a very hard way to make money, and feels a little.
It is like there is a little bit of I don't think people necessarily admit as much as they should, but like obviously there's some larger cap firms out there that will kind of do full spectrum investing. So they'll write seed A checks, but they'll also write $100 million Series D or whatever. And so for them, it's a little bit different in the sense that like they'll potentially pay up for those rounds, but like that capital is just a rounding error, right? Like the things that matter for them are like, hey, do I have access to this deal at a C or D or E stage where I can write the $100 million check in something that I'm excited about? And this all other investing is just loss leader stuff to try to get a pro rata right or an inside advantage to potentially write a much bigger check later. And so the math for those folks in paying up makes more sense because of what I just described. The unfortunate thing for entrepreneurs, which I'm not sure if everybody realizes, but we definitely try to impart it, is like getting your valuation out of whack can have downstream ramifications. Because like if you're not that on track to be a $10 billion company, like that big firm, like that you thought gave a big shit about you probably doesn't care anymore. And everybody else that might kind of see your business through to a $200 million outcome, which still could be quite lucrative to you, doesn't want to pay 100 for a pre-revenue business. And you've now kind of put yourself in a pretty tight and narrow box. And for you selling your business for 100 or $150 million, like that big VC firm doesn't care if you sell it for 150 or it goes to zero, because that doesn't matter at all about the economics of like what their fund is going to produce. So they'll run it in a fashion, or advise you to run it in a fashion where like you're pushing the envelope and it's either going to be 10 billion or zero. And I'm making gross generalizations, but for the point of making a point, which is just very different from yeah, hey, if you're an entrepreneur and you're going to put 8 years in your life, like you making $10 million out of this is a lot different than you making zero. So you just keep in mind that like people are partners for a long time. You can't fire your board members, generally speaking, and you want alignment between. That doesn't mean you can't go for a $10 billion outcome, but if for whatever reason along the way it steps off that, like the alignment of like, hey, this is still interesting and I want to optimize for a different outcome, like has to be or should be part of your calculus, unless as an entrepreneur, you're like, this is going to be 10 billion or zero. And like, if it's not 10 billion, I'd rather blow it up too, in which case, do whatever the hell you want. I think that's really important. No one likes to talk about like middle of the road cases or downside cases in venture, but like the reality is like that's the majority of outcomes. And so like people should think about it.
Well, Morgan, look, this is a really fun conversation. I appreciate you coming on the show.
Yeah, thank you for having me. Really good questions, by the way, diving into some great issues. So I'm glad we had a chance to talk through it.
Thanks for listening to the show. We really appreciate the support and would love it if you'd subscribe to the podcast on iTunes, Spotify, or your preferred podcast platform. One more thing. Investing in startups is not of sponsors, but I want to give a shout out to one of our portfolio companies, Micro One. Micro One helps businesses ranging from startups to enterprises to source world-class software engineers. Micro One uses their own AI tools to identify top 1% engineers and get them working for customers in as little as 48 hours. And if Micro One could help one of the largest AI companies in Silicon Valley hire 250 engineers in 30 days, they can probably help you too. If you'd like to learn more, visit microone.ai. And thanks for listening.
Joe Mager is the founder and managing partner of Seaplane Ventures. The content here is for informational purposes only and should not be construed as investment, legal, or tax advice. The opinions expressed by guests are their own and do not reflect the views of Seaplane Ventures. Our host, guests, and clients may hold investments discussed in this podcast. Please invest responsibly.